Welcome back to Stock Spotlight, where I usually break down individual stocks. But today, I'm hitting pause to talk about something foundational: how I tilt my portfolio with factor investing. You do factor tilting in a portfolio by buying a total market index mutual fund like SWPPX or an ETF like VOO and overweight different factors through additional ETFs. If you've ever wondered what small cap value, momentum, or quality actually mean, then this episode is for you. Let's get started. Let's start by setting the foundation. Most of the long-term alpha in markets, the kind that shows up across decades and different countries, can be explained by a handful of well-studied return factors. For ease of remembering, I split these into core, extended, and practitioner core factors. Core factors are the heavyweights, the ones with the deepest academic backing and longest history in real-world investing. They are persistent, meaning they show up over long periods; pervasive, which means they work across geographies, sectors, and asset classes; and robust, which means they still work when measured in different ways, for example, PE versus price to book for value. Extended factors are more like specialized rooms added later, still solidly built on research, but newer to the scene or less common as standalone exposures. Practitioner core factors are the ones that sit outside the classic FAMA French models, but in the real world have become staples in portfolio construction. They have decades of supporting evidence, work across markets, and are easy to implement through ETFs. So even they're not originals in the academic sense, they're treated as must-have building blocks by many investors. Now, there are two main reasons why these factors exist in the market. The first is a risk-based view. Factors reward you for taking on certain risk that the broader market is either unwilling or unable to bear. For example, small caps are more volatile, value stocks often have business uncertainty, and then this excess return is then a fair compensation for enduring higher volatility, drawdowns, or economic sensitivity. There's also this behavioral view, which believes that these factors are explained by mispricings that persist because investors overreact, underreact, or have constraints, for example, institutions avoiding low-vol stocks. Momentum premiums often persist because of investor overreaction and underreaction at different points in the cycle. Large cap momentum trades can be slow to unwind due to crowding and benchmark constraints, while small cap moves can overshoot quickly due to lower liquidity, creating both opportunities and whiplash risk. Let's now talk a little bit about the core factors. Fama in French, the economists who popularized factor models, originally only studied three factors in their 1993 model: market beta, size, and value. Market beta is broad equity market exposure, for example, SPY or SWPPX, and it represents the beta term in the capital asset pricing model, or CAPM, and this captures the return attributable to overall market risk. For size, small caps, and think in terms of market cap, tend to outperform large caps over time. There's ETF examples like IJR and VB with size exposure. Size is categorized as a pro-cyclical factor, meaning that it tends to benefit during periods of economic expansion. Size is also interesting because there's some strong evidence that while it may not be an important risk factor on its own, it pairs especially well with other factors like value and profitability. In fact, the strongest value premiums often show up in small caps with high profitability, which is why small cap value is a classic factor combo in both academic studies and practical portfolio construction, because it has the highest expected return of any category. And ETF examples of small cap value include AVUV, AVDV, and VBR. Next, let's talk about value. So value is stocks trading below intrinsic value using metrics like PE, PB, free cash flow yield, etc. And ETF examples include QVAL, QVOL, IVOL, and AVES. Academic research on the premium demonstrates that value stocks have riskier earnings and profitability compared to growth stocks. From 1927 to 2021, based on annual premiums from the Kin French Library, the US value premium was about 4% per year over growth stocks, and it had a 0.27 Sharpe ratio, which was actually the second lowest only to size. This return has been lumpy. It did very well from 1970 to 1995, but now values had a long drought over the last 10 years. And in fact, the MSCI USA Growth Index has gained 356% over the last 10 years versus 91% for the MSCI USA Value Index. This factor has typically paired well with momentum in portfolio construction, as they have been historically negatively correlated. ETFs like AAVM actually combine factor-based value and momentum ETFs into one basket, which is pretty cool. For the extended factors, Fama and French added profitability and investment in 2015 to form a 5-factor model, and then later research incorporated momentum into a 6-factor version. For investment, now this is firms that invest conservatively, so low capex or asset growth, and they actually tend to outperform, which has led to the CMA or conservative minus aggressive factor. One explanation I find interesting on why this is the case is that an acceleration in capital spending occurs during a period when demand for goods is strong, and the company decides to invest a portion of its improved cash flows into capital programs to grow the business and meet what appears to be robust demand. Often, however, by the time the new plant or facility is completed, the demand environment changes. And from 1964 to 2021, the conservative investment premium averaged around 3 to 4% per year, according to PWL Capital's analysis of Fama French data, and it often overlaps with quality and value exposures. One thing to call out with this factor is that it should not be interpreted to suggest that a company's capital spending should ever go below its maintenance capital spending level. Next, the profitability factor. So this is highly profitable firms, and you can measure it through gross profits to assets or gross and operating margins and several different ways beyond those two. But they tend to outperform. In the 1927 to 2021 study, the profitability premium has averaged 3.5% annually with a 0.36 Sharpe ratio. This was higher than size or value Sharpe with much lower volatility at a 9.7% standard deviation versus 13.4% and 15.3% respectively. So controlling for profitability dramatically raises the performance of value strategies. Next, my favorite factor, momentum. This is when past winners tend to keep winning in the short to medium term, especially over the next 3 to 12 months. And some good ETF examples of this factor in practice are MTUM, MTUM, SPMO, QMOM, QMOM, and IMOM, IMOM. While not part of the original Fama French models, momentum appears in some 6-factor variants and has been studied extensively since the early 1990s. From 1927 to 2021, the momentum premium delivered around 9% per year over the risk-free rate with a 0.58 Sharpe, and this was actually the highest risk-adjusted return of any major factor. The MSCI USA Momentum Index has also beaten the MSCI USA Index by 3% since 1994. Momentum has worked in virtually every asset class studied, including equities, bonds, and commodities, but it's a very broad concept and has lots of ways to implement. So let's talk about some of these ways. There's typically 2 ways to understand momentum: by type of signal and by implementation approach. So first, by signal. There's price momentum, which is based purely on historical price performance. And this is stocks with the highest past returns, typically over 6 to 12 months, and skipping the most recent month, and they tend to outperform those with the lowest past returns. Variations of this approach include idiosyncratic EMA divergence using moving averages, which can produce cleaner signals, and then also the frog in the pan approach, which focuses on stocks whose gains come from many small, steady advances rather than a few big jumps, which has been shown to reduce reversal risk. There's also fundamental momentum, which is based on improving company fundamentals, such as upward earnings revisions, accelerating revenue growth, or expanding margins. We can also look at momentum by implementation approach. And the first one is relative momentum. This ranks assets against each other and invests more in the strongest performers while underweighting or avoiding the weakest. Here's an example. You would choose the top 20% of stocks based on 12-month returns. Then there's absolute momentum. This compares each asset's recent trend to a benchmark, like zero return or a moving average, and stays invested when the trend is positive, shifting to safer assets like cash or bonds when it's negative. Here's an example. Holding an index when it's above its 200-day moving average, but moving to cash when it's below. There is also a couple of risks and nuances to understand with momentum. The first is turnover and cost. So momentum strategies typically have high turnover, and this increases trading cost and has some tax drag, although ETF wrappers do help. There's also momentum crashes to be aware of in sharp risk-off events. And this is when there's a tech bust or the COVID whipsaw. And when this happens, high momentum stocks can drop the hardest. Let's now discuss two practitioner core factors. And these are factors that investors incorporate in the real world. The first is quality. So you can think of quality as high ROIC, ROE, ROA, low debt, stable earnings, etc. A couple of ETF examples are SPHQ and QUAL. Now, in AQR's global study, which ran from 1958 to 2021, quality earned around a 4.6% per year premium with a 0.47 Sharpe ratio, which was nearly as strong risk-adjusted performance as momentum, but with less cyclicality. Academically, from the research I found, quality overlaps significantly with profitability, but in practice, it's often implemented as a distinct tilt. The next practitioner core factor we'll talk about is low volatility. This is the anomaly where lower beta stocks actually outperform higher beta stocks on a risk-adjusted basis. One ETF example is USMV. Research goes back to Hagen and Hines in 1972 and Frazzini and Peterson in 2014 that shows low vol portfolios often match or slightly exceed market returns with 20 to 30% less volatility. And this results in Sharpe ratios around 0.50 versus the market's 0.44. The premium is persistent across regions and asset classes, and it's often explained by leverage constraints and institutional underweighting. Now, a note on academic research versus real-world implementation with all of these factors. Most academic research is conducted on long-short portfolios. These models rank securities, go long the top decile, or high factor exposure, and short the bottom decile, low factor exposure, which often boosts the apparent factor premium and reduces correlation to the market. In the real world, most factor ETFs are long only because shorting at scale is costly, tax inefficient, and operationally complex. This means the realized factor premium in a long-only ETF should typically be smaller than what academic studies report, since you're not benefiting from the short side. For practical investors, it's more about getting a meaningful tilt within a diversified portfolio than perfectly replicating the academic long-short results. Now, if you do want true long-short factor exposure, then I'd advise you to take a look at BTAL for the low volatility or anti-beta factor, and AQR's long-short equity fund for a multi-factor approach. Before we jump into how I actually tilt my own portfolio, it's worth noting that factors aren't free lunches. They come with implementation frictions. Smaller, more niche factors can have capacity limits. If too much money chases them, the premium can shrink. High turnover factors like momentum require careful execution to minimize slippage, market impact, and tax drag. This is why ETF selection matters. Two value ETFs might have very different actual exposures, trading cost, and tax efficiency. The premium you see in backtest is always before these real-world frictions. With that said, in totality, I think of my portfolio like a three-layer cake, excluding alternatives, precious metals, and cash in this case. So we've got the S&P 500 core base, then I have factor ETF tilts for extra flavor, and individual stock picks on top for fun and potential upside. Here's how I actually tilt my portfolio today. I own SWPPX, which is a low-cost S&P 500 exposure for market beta. I have AVUV, which is US small cap value. It adds size, value, and profitability tilts across 750 plus stocks. I also own AVDV, which is the international small cap value, and a similar thesis to AVUV, just overseas and with around 1,500 stocks. For my momentum exposure, I use QMOM, QMOM, and it is a mid to large cap momentum tilt, and it does have high turnover, but strong historical persistence and high momentum factor loading versus other momentum ETFs. What I also like about QMOM is that it only owns about 50 holdings at any time. There's also IMOM, which is the international version of QMOM, and while I don't own it, it has had a great year-to-date run so far, and it's up around 30% versus minus 3% for QMOM. IMOM is probably the one factor ETF that I haven't added, but could consider adding in the future for that international momentum exposure. The main reason why I haven't is that AVDV is owned by Avantis, and they actually do consider momentum to help inform trading timing. So I've been a little bit cautious about an IMOM on top of that, but it is certainly worth a look. I also own Freedom, FRDM, and it's not really factor-based, but ironically, it actually has indirect exposure to the investment factor through its emphasis on emerging market countries with higher economic and political freedoms. And this often results in lighter allocation to state-controlled companies. Now, Freedom has around 100 emerging market holdings. If I had to build my portfolio from scratch today, I'd probably start with AVGV because it delivers global all-cap value exposure in a single ETF. And it covers US, developed ex-US, and emerging markets with a consistent factor tilt. It simplifies implementation while still capturing the diversification and long-term return potential of value investing across the world. This mix gives me exposure to 7 of the 8 factors we discussed earlier. So the only one not directly covered is quality, which I actually target through my individual stock picks, and that's why my research checklist outputs a quality score. Excluding SWPPX, these factor ETFs make up around 23% of my portfolio, serving as deliberate tilts layered on top of my core index exposure. On paper, factors look like a no-brainer. You see the long-term backtest and think, why wouldn't I want a piece of that? But in the real world, factor investing tests your patience, your conviction, and sometimes your sanity. There's 3 ways this can happen. The first is tracking error. And tracking error is the difference between your portfolio's returns and the benchmark's returns. And it's often driven by your factor tilts. An example, if your factor ETF has high active share versus the S&P 500, which means a large percentage of your holdings differ from the benchmark index, then even in normal markets, monthly and yearly returns can deviate widely. That's a feature, not a bug. This is why I also believe in combining different factor exposures, as it can help reduce that tracking error volatility without killing the factor premiums. As a factor investor, we also have to worry about drawdowns and factor droughts. There will be long stretches of relative underperformance that can happen even when the factor works over decades. Value famously underperformed for nearly a decade from 2010 to 2020 during a growth-dominated bull run. Momentum is powerful, but it's vulnerable to sharp reversals, especially after big market rotations. And the premium decays quickly after around 10 to 12 months, which is why many momentum ETFs underperform after fees unless they're well structured and turnover is managed smartly. Size has long-term merit, but small caps can be crushed during mega cap booms. There's also behavioral risk. Selling a factor ETF after years of lagging the market just before it recovers. Or abandoning your chosen implementation because of short-term pain. The hardest part isn't finding factors, it's sticking with them and the ETF, which is not easy. I'd like to finish now by providing a couple of practical takeaways for both beginners and advanced investors. Factors can either replace part of your core allocation or overlay on top of it. You don't have to go all in on a factor tilt for it to make a difference. Even a modest 10 to 20% allocation can meaningfully shift your portfolio's long-term return and risk profile. The key is knowing what you want the tilt to do for you: boost returns, reduce volatility, or diversify sources of risk, or all three. Now, for beginners, I recommend that you keep your S&P 500 core intact. Think of it as your foundation, with factors as the flavor shots. Look under the hood of each ETF you are considering by reading its prospectus and index methodology. AVUV, for example, uses profitability screens and adjusts for goodwill in book value calculations, which can subtly change the factor exposure compared to a plain vanilla value fund. I then recommend start small with 1 to 2 factor ETFs, something broad but targeted like an AVUV or VBR gives you a clean value and size tilt without overcomplicating things. And don't try to time your factors. The real edge comes from tilting and sticking with it through the inevitable dry spells. And then also make peace with tracking error early. If you want to beat the market long term, you have to look different from it in the short term. Start thinking about factor correlations and pairing low correlated factors like value and momentum to smooth out the ride without killing returns. And then finally, I recommend doing some research on 3 companies with some very interesting ETFs in the factor investing space: Alpha Architect, Avantis, and Dimensional Funds. Now, for advanced investors, I'd recommend that you track your active share versus your core benchmark over time. This can help assure your portfolio is still differentiated enough to justify that tilt. I'd recommend using Portfolio Visualizer or another tool's factor regression analysis to test your ETF's factor exposures. This shows how strongly a fund loads on different factors and essentially reveals how pure your tilt really is. I recommend doing this every couple months, maybe 6 months to 12 months, as new data comes in. I'd also recommend deciding whether factor purity or risk-adjusted returns matters more to you. For some, the highest factor loading is the goal, maximizing exposure to the premium you're tilting toward. For others, the Sortino ratio, which is returns relative to downside risk, matters more. You need to decide which one is better for you. 3 more tips for advanced investors: monitoring live factor performance using resources like the Ken French Data Library or AQR's factor dashboards. If your factor tilt stops loading where you expect it to, it might be time to reassess the ETF or methodology. And then factor in turnover, liquidity, and capacity constraints. High turnover factors like momentum need efficient execution to avoid slippage, while small cap and niche strategies can have capacity limits that affect returns if assets grow too large. And then finally, for taxable accounts, analyze tax efficiency. Value and quality tilts tend to have lower turnover, while momentum and multi-factor funds can generate more short-term gains with higher expense ratios. Factor premiums don't show up every year, sometimes not even every 5 years. You want to judge factor performance over full market cycles. The right way to measure isn't just did I beat the S&P, but did my factor ETF deliver the tilt I wanted, and is that tilt still present? In short, know your factors, know your funds, and give them the time and space to work. The real payoff comes from patience and precision. Thanks for tuning in to another episode of Stock Spotlight. If this episode helped you understand factor investing better, subscribe on Spotify, Apple Podcast, or YouTube, and share it with someone who's still 100% at SPY. For real-time updates and insights, follow me on X at Invest091. Join me next when we'll dive into Badger Meter, ticker symbol BMI. Until then, keep your investments smart.